Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, will provide you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Well, welcome to the Real Estate 360 program today, your number one source for all of your real estate needs here in the Bay Area, where we provide you with the information that you need to make the best fact-based decisions. Nice to have you with us today. We have a topic that I think is very important, and that's insurance for rental properties. And that's something that we often maybe don't want to talk about, but pretty important unless you're financially independent and want to self-insure. Most of us want to have some insurance, but it gets a little more complicated right after that. What's the right amount? What's the right kind? What do we do about rental property? How do we handle liability versus hazards and so forth? So we have a special guest today, Michelle Pepper with Davis-Dyer-Max, an independent insurance agent and broker in the Dallas, Texas area. And I've known Michelle for, about 13 years now. And she's kept me out of trouble and given me the right policies. So we're going to walk through insurance for the investor, see what it's been like in the past, what it's like now, what the options are, where it's headed, and then you can get information on how to contact Michelle if you have more information. So I'd like to bring Michelle in and introduce her. Michelle, good afternoon. Nice to have you with us.
Thank you. Glad to be with you.
How's the weather out there in Texas here in Dallas in this new year?
Very rainy, and it's cold. We had snow on Christmas Day.
All right. Well, there's a white lining, to your Christmas story.
Yeah.
Michelle, to start off with, why don't you tell our listeners a little bit about your background, how long you've been in this business, and about Davis-Dyer-Max that you're with.
Okay. I have been in the insurance business 35 years, and you're right. Most people do not like insurance, but 35 years later, I still love it. I worked for another insurance agency up until about 5 years ago, and now I'm an agent, and I'm working with Davis-Dyer-Max. They have been around in the Dallas area for almost 60 years. So a lot of knowledge here in our agency.
How many folks work at Davis-Dyer-Max, and how many agents are there about?
I think there's about 28, 29 people total, and there's probably 7 or 8 agents here.
So you might talk a little bit here, let our listeners know that, there's just like there is with lenders and many other businesses, there are those that sell only their in-house product, like a State Farm or Allstate, and then there are other independent brokers like Davis-Dyer-Max that go look for the best policy from any of the suppliers out there. Correct?
Right. Yeah, we try to go out and do the homework for you and shop it, try to get the best pricing, and that's something you can't do typically, with the Farmers and Allstate, because we do have a lot of options.
And you know about those differences because you were with one of those big ones for a long time, weren't you?
That's correct.
Okay. They all have their place.
Yes.
Let's start off by talking a little bit about what's the difference in a policy for an investor for a rental property than the policy for an owner-occupant. I think many people don't realize that there are differences in the basic policies and lots of different considerations and different pricing structures and so forth. Mm-hmm. So let's talk about those differences.
Okay. On the homeowner side, typically the cost is higher. There is more coverage number one, just because there's, the owner living in the home. So I would say, between the home policy and then a rental policy for an investor, the main difference, there's no contents for the investor policy unless you want to add it. And that's what's good on an investor side is we can kind of build the policy to what your need is. So let's say you want to have, the house has a detached garage. Typically, on a homeowner's policy, there's coverage. On an investor rental policy, unless we endorse that onto the policy, it's, there's no coverage. So typically, I would say an investor policy is less money just because of being able to be creative.
And it's less, it's fundamentally starts at a little bit lower coverage, but you can add on what you want to get the kind of coverage that you want.
Correct.
Okay.
So that's what's neat about the policies that we sell to the investors.
Maybe a little bit more like our classic Detroit car that you can get the basic price and then you add on features that you you want.
Right.
How does the what are about liability, for example? Isn't liability policies usually separate for a investor? Yes,
and the way we do it, we have 2 or 3 companies that we have found have the best pricing of anybody that around, and it's basically 2 policies, one for the structure and the other one for the liability, and they package them together, but they are 2 separate policies. And the liability is typically you go with a $1 million limit, a $2 million aggregate.
And we'll talk a little later, I think, about umbrella and how that ties in with that.
Okay.
Talk about the vacancy issue. That's
that's always a good one.
that's a factor that makes it awkward at best at times, doesn't
it?
Because rental properties are sometimes vacant, most of the time occupied. What do these insurers want?
Well, the number you need to remember is 60 days from the date the furniture is moved out. The good thing about the policies that we have found that we're writing is these companies, they know typically the day you close that there's not going to be somebody, possibly in the house. There may have to be, a few repairs. So it gives you a little time before, that 60-day vacancy starts. So these companies have developed something now to where after the 60 days, if it's still vacant, we add what they call a vacancy endorsement, and there is no charge for it, which is unheard of in the insurance industry.
Now, is this one insurer in particular that's doing this?
One of the companies, yes, that is something they do. Now, when you add that vacancy endorsement, it does exclude theft. But you still have all of your other good coverages. And that, to me, makes that policy just, the best.
What's more typical with other insurers after that 60 days? Are most of them 60 days?
Well, there's all types of answers to that, but, coverage will be lowered. If they do add a vacancy endorsement, there's a charge for it, and it's a pretty significant amount of money. So when this company came out with the, they're not going to charge anything for it, just take off the, theft coverage, it's a good thing.
So more typically, most companies will give you some time that's okay to be vacant, but after that, supposedly, they don't want to continue the policy, right?
Right. It just depends on the carrier, but that one thing you just need to always remember, and I talk to property management companies all the time, if these homes are vacant for more than 60 days, give us a call, because we do need to address it and figure out what to do.
So that's even more additional incentive for an investor. They should be looking for a property and a location in the metro that has a strong economy and strong occupancy, and anyway, and so this is just one more reason why it's pretty darn important to make sure that you've got a property that's in a good area with good occupancy, that a property that isn't in such bad condition that's going to take you 90 days to get it fixed up to the point of even being able to start trying to get a lease, right?
Correct. That is true.
Now, does price vary on hazard insurance depending on the number of units that someone owns?
Definitely. What I typically do, and if it's a new investor that's just starting out, going to kind of test the waters, I have a policy, and it's a single residential policy that I normally will start them with, because you get your better pricing on these master commercial policies if you have 4 to 5 units. But most investors don't purchase that many, especially all at on the same date. So what we might start out with is just a residential policy for one location, and then, maybe 2 or 3 months later, they have now, acquired 5 of them. Then we will get pricing for the 5, and the pricing is much better.
So I presume that there are many carriers that maybe do not offer a blanket policy. Is that what that what you like to call it, a blanket policy?
Yeah, that's a good way to put it. I mean, they have all different terms out there, but yeah. There's not a lot of companies out there that will do that, but we have 2 of them that are very good.
So when an investor is starting off, that's pretty important for them to realize that as they start to scale up, their insurance cost per property will come down.
Correct. So that's the reason I've kind of figured all this out through, just working with different investors, that, if within a few months they're going to have 4 or 5, that's why I start out with this other policy. And you will get all the premium returned to you. Let's say you keep it in force for 2 months, and then we move it over to this blanket policy. They will refund all the amount back to you, that's unused. Mm-hmm. So that's a plus. And then, you end up getting a lower cost per unit by moving it to the blanket policy.
Okay. We're talking today with Michelle Pepper with Davis-Dyer-Max in Dallas, Texas area, Dallas-Fort Worth. And she's talking to us about how rental policies are unique for investors and how we can make the best choices on what to get. So when we come back, we're going to talk about what's unique about Texas and what minimum insurance requirements are and some of those topics. And so stay with us. We'll be back in just a few moments on KDOW 1220.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Well, welcome back to KDOW at 1220 AM, the Wall Street Business Network. We're talking today with Michelle Pepper in Dallas-Fort Worth area about insurance, one of those things that we maybe would wish we didn't have to talk about, but it's very important. And if you put it off till later, you may be sorry. Michelle's helping to guide us through what's the best kind of policies to get for an investor and how to navigate our way through all of the options and so forth. So welcome back, Michelle.
Thank you.
And let's move now into let's talk about what's unique about a policy in Texas versus other areas. Now, one point on the last subject we were talking about with price varying by number of units doesn't make any difference where the where the properties are, do they? They can still put multiple properties from multiple states on one blanket policy?
Yes, some of the states do. There's different guidelines for that, but yes, some of the states you can combine. So, and I write all over the United States, so the ones that we can, combine, we do. Texas is a little unusual, and their policy is not user-friendly to the other states. So typically we cannot put other states on with the Texas locations, but we can combine other states.
Mm-hmm. Okay. And I think maybe I didn't mention it on the intro, but my favorite area to invest in is Texas and Dallas-Fort Worth specifically, even though I live in Silicon Valley and Northern California, because it cash flows well and the economy is very, very strong there. But, of course, every region, no matter where you invest, has its negatives. And maybe one of the negatives in Texas is that we have some hazards that are somewhat unique compared to other states. So we don't have earthquakes or tsunamis down there, but we do have wind and hail and some tornadoes, don't we?
Yes, we do.
How does that affect the policies there in Texas for investors?
Well, it's last year, 2012, in my 35 years in this business, was the most unusual year for claims that I've seen, and I think this was really, the entire United States has seen a lot of this claim activity. And it does, impact the rates. But, when you look and you see that, I would say, hail claims, we have, hail here. And I would say your typical, rental, is probably an $8,000 claim. You are out your deductible, but then you have another probably 25 years of a new roof. It does impact the rates. We're starting to see the rates go up, on the policies because of this. But, we had tornadoes. We had 2 different tornadoes touch down in April of 2012 here in the Dallas-Fort Worth area. And I had some of the houses insured that were level to the ground. And I think that you could talk to any of my clients that, had to turn in the claims, and they were, paid policy limits. So I've had very good claim feedback from, when you do have to submit a claim.
And that's a good topic. I guess there are probably some there's some insurers out there that are quite small, and maybe the premium is a little bit less, but you want to make darn sure that when you do have a claim, which is the whole reason for having insurance, is that they can stand behind it and pay out, and especially if there's a heavy hit in one region and that insurer is a little bit heavily insured in that area.
Right.
I've kind of always considered that, you pay a little bit more premium than you do maybe some other areas for the insurance, but you kind of have a roof insurance on a certain percent of my properties. Over time, I wind up with a new roof, so I kind of figure it washes out.
That's correct.
Let's talk about the minimum insurance. What's the least amount of insurance you can have? And just give a little intro to that, and then we'll come back and get into some more detail after the next break.
Okay. 80% is what the state of Texas requires you to carry on a residential structure to where you won't have any depreciation at claim time. So, we use a Marshall and Swift calculator, and we put in the square footage, year built, 1 or 2 story if it's a slab. And I have this question all the time: how come the cost is higher to rebuild than the sales price, versus the appraisal district?
Well, let's go into detail on that in a couple moments when we come back with Real Estate 360 on KDOW.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to KDOW, 1220 AM, Wall Street Business Network, where we have today Michelle Pepper in Dallas-Fort Worth area, helping us navigate through the waters of how to pick the best insurance and where it's headed in direction and so forth relative to rental properties. Michelle, so let's go in a little more detail here on how it's determined what the minimum insurance is that can be carried and still get full coverage in case of a claim.
Right. Typically it's probably driven mostly by the square footage, but the zip code is a factor. There's probably 10 or 15 different things that they factor into this to come up with replacement cost, and then based on that number, we typically, for the investors, insure it for 80% of that amount.
And that number that's calculated is the insurance industry's basis for figuring out what the replacement cost is?
Is for that area,
for that region,
code, for that region, county,
and for that type of construction, etc.
Yes, whether it's brick or frame.
And then
we just input all that. It just it gives us what it should cost to rebuild it.
So you take that as a reference point, and then you, as long as you have insurance, which is at least 80% of that, then if you have a total claim, you'll get the total amount for replacement.
Correct.
Is that right?
Mm-hmm. Right.
Okay. Let's talk about different levels of policies. You mentioned earlier that you can tailor policies a bit. But it's a little bit less variation in policies than it used to be.
Yes, we used to offer a policy that had less coverage on it, but the industry has kind of moved it on toward what we call the special form policy, and it's the broadest type of coverage that we have available, for the rental dwelling investor. You can insure, if you want to insure the house for 100% of coverage, you can, or you can go anywhere between that and 80%. You're in control of what the amount is once we establish replacement cost.
Now, our lender only requires enough coverage for the loan amount, right?
Yes. Mm-hmm.
But an insurer will not. They would, I guess, allow you to have less insurance at times, but they're not going to pay out the full amount if you have a claim.
Right. And a lot of the companies are moving away from that. They used to let you do what they called an actual cash value policy, and they don't do that as much as they used to.
They more want to have a
replacement cost.
They want you to have enough insurance that they can cover replacement.
Correct.
Okay. All right. And what are some of the options that are available for additional coverage beyond the basics?
Well, you get your, fire, wind, theft, and then you can...
Those are all part of the basic.
Right. Well, as far as basic, fire and lightning are your basic coverages, and you kind of build on that. Some of the things that the policies, these rental policies do not cover are like fences. And I think we talked earlier about the adjacent structures that, we would need to know that up front to get you coverage for that. Sewer backup is not a covered item on these policies. So, people say, well, what does that mean? Just always think of it as clean water. If you have a faucet or a pipe that burst, you've got coverages for those.
Okay, let's cover a little bit more of that detail when we come back. We got to break here for a couple minutes, and then let's review a little bit more what some of these options are. We're talking with Michelle Pepper in Dallas-Fort Worth regarding insurance on KDOW 1220 AM on the Real Estate 360 program.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Okay, welcome back. We're talking with Michelle Pepper on the subject of investors' insurance policies. Michelle is with Davis-Dyer-Max in the Dallas-Fort Worth area. And Michelle has probably supplied several hundred policies for myself and my friends and clients.
I have, indeed.
And it's done a great job. If I want to know something about insurance, Michelle's my first call.
Well, thank you.
Let's go back to the subject we were covering just before the break on the options for policy coverage other than the basics. So we're talking about I guess what the industry calls exclusions, right?
Right.
So you can get coverage for these things, but they may cost more, and things like fences and
well, now fences under this commercial policy, there is no coverage.
Okay.
That is one
exclusion
that they do exclude, and sewer backup. I like to tell people those are two things that you're just not going to see any type of coverage on these rental dwelling policies.
And can you even get an option for it?
Not on this policy.
Okay.
It is excluded.
If somebody wants that, are there other kinds of policies they can get, but it'll cost them dearly?
You can probably get some fence coverage, but the sewer backup, most of the rental dwelling policies in Texas do not offer it. Now, there may be some other companies out there that I'm not aware of, but I have not found one myself that offers that.
And most policies in general, and I think this is true nationwide, isn't it, do not cover any more, they used to at one time, do not cover earth movement and do not cover surface water, right?
Definitely, the earth movement, yes, everybody has shifting and things on that. Now, the surface water, are you talking about flood?
For flood.
Right.
As opposed to a sudden and accidental break inside the house.
Right, yeah. No, you have to carry separate flood insurance, just like you have to do on the earthquake, since these policies do not have any of that coverage on them.
If the wind blows a hole in the roof, a section of the roof off, and the water comes in and damage, does that get covered if you have wind coverage?
It has water damage on it. It's just there's no flood coverage. A flood is considered rising water.
Okay.
So, these other types of things, whether it be a refrigerator that, the ice maker, develops a leak or, something like that where it's water going into the house, under the carpet or whatever. Yes, things like that you do have coverage.
Generally, sudden and accidental is covered, and something that's slow, that is a leak that rots, is not, right?
That's correct.
Okay. All right. Let's move on to liability insurance.
Okay.
So some of these policies don't automatically, for investment properties, do not cover liability insurance, right?
Right. It's two separate policies. The liability policy that I typically offer it's a $1 million per occurrence, $2 million aggregate. And that means that you could have basically two $1 million claims in one policy term. Let me say something there, because a lot of the companies, and regardless of where people end up getting their insurance, you need to make sure and ask the question, does this policy have an animal exclusion on the policy? A lot of these investor-type policies have gone to that, and we are just continuing to make sure that the policies on the liability side, there's not an exclusion for that, because I think that's very important, because everybody has dogs.
And when they say animal exclusion, does that mean Any animal, doesn't make, not just
Any,
aggressive breeds or anything.
That's why they call it an animal. Yeah, I mean it's any type of an animal, and it's excluded. I mean, your typical one is a dog bite, which we don't see, hardly ever. But I mean, it is possible.
But you want it there. You want to have it.
You do. So that's the reason I always steer toward the policies that do not have that exclusion on it.
So again, for in the broader scope here of the liability policy, again, it's much cheaper if someone has several properties with liability blanket over it than just individual, correct?
That is correct, yes. On this policy, it has a $400 minimum premium. So if you have, however many locations, you can split that among that. Where the actual charge might only be $50 per location. If you purchase the first property, that $400 would be charged against that first property. But you would probably be able to add another probably 4 to 6 units to it without there being an additional charge for liability, since you paid the $400 minimum in the beginning.
Well, I think some people don't carry it, liability insurance, but I think it's pretty important.
I think it's very important. Yeah.
Let's talk about umbrella and how that couples with it. So explain what umbrella insurance is.
Okay. Basically, that just gives you more coverage. The umbrella that we sell, it's about $500 per million, up to $5 million. And it just gives you, an additional $1 million worth of coverage in the event there were, some type of a catastrophic loss. Which
I consider that to be pretty inexpensive.
I think it is.
And also, it should be noted that they have an underlying insurance requirement, right? Which
that is correct, and that's what when we were just talking about the $1 million per occurrence. That is your underlying. And
now, do most umbrellas require $1 million underlying or $500,000? What's more common?
Most of them. I mean, there probably are some that only require the $500,000, but there's not but a few dollars difference between the $500,000 to the $1 million regular liability. So in my, process of thinking it through, I think it's better for just a few more dollars to go ahead and go with the $1 million, because then you've got more coverage.
Yep, I think so too. We're talking with Michelle Pepper with Davis-Dyer-Max in Dallas-Fort Worth. We'll be back in a couple of moments here and discuss more about, wrap up a little bit about insurance on KDOW 1220 AM.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. We're talking to Michelle Pepper about rental property and insurance. Michelle has supplied insurance policies for my properties and my clients for about 13 years and has been in the business for how long, Michelle?
35 years.
Wow. And you look so young.
Thanks a lot.
So we're going to wrap up here a little bit. So let's just finish the couple comments there about liability and umbrella insurance. So umbrella insurance gives you a higher level of insurance at basically a more economic rate than if you tried to get that same level of insurance on each policy for each property, correct?
Right.
So it's a very, very efficient way of getting that liability insurance.
Correct.
And I tell people all the time, a lot of people ask me, how do you title your own personal holdings? And they're shocked when I tell them that I don't hold them in LLCs or anything else. I have them in a family trust, but that has no liability protection. They say, well, how do you protect yourself? I said, well, that's liability insurance and umbrella. So I carry a very large umbrella policy because I think, and I carry, relatively high deductibles on hazard. because I'm more concerned about the big problem. And
Right.
and I think that's one of the misnomers that people have is they forget they want insurance to cover every little thing, and it's very inefficient that way. Insurance was meant to cover big items
The large loss.
that would be very damaging for you personally if you tried to cover it that way, right? You agree with
Right.
that, I'm sure.
Mm-hmm.
Any
Yeah.
particular trend in the insurance business these days, either nationally or in Texas, other than rates in any area will go up some for a while until they, if they have to cover a recent disaster. But
Right. And I have seen them go down. I mean, it's
we've
it's
seen that over the years, haven't we?
Yes,
Since we've been working together.
right. So I just think that I hear from some days 4 or 5 new investors. A lot of people are coming into the Dallas-Fort Worth market, wanting to purchase homes here, and we've had our share of the foreclosures, and they're pretty attractive pricing, and a lot of people have started doing that, and they're converting their 401ks and everything to try to be a wiser investor.
Yep, certainly still my favorite place to go. Economically, it's done very well. You just want to know what the uniquenesses are of any area that you're moving into investing-wise, and one of them is the insurance policies may vary a little bit from region to region, but most of what we've discussed today, I think, are nice general input for our listeners, regardless of where they are.
Right.
So, Michelle, what if people want more information about insurance in general, or what you can provide, how can they get hold of you?
The number at the office here is 972-864-0400. My extension is 243. Or if you want to just get me on my cell, it's 214-212-6423.
Michelle, thanks so much for being with us. And if you have questions for me, Tom Wilson, you can email me at tomkwilson@earthlink.net, or go to my website, tomwilsonproperties.com, and you can call me on 408-867-1867. Thanks for being with us. It's been nice having Michelle Pepper with us today to help us navigate the waters of insurance. And, Radio Real Estate 360 is on every day of the week, and we hope you can join us the other days and join me next Wednesday. Well, thanks for listening.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. AM 1220 KDOW.